Righto, buddy waters, welcome back to another Yarn Brewer delivered by Axis Mining Technology. Mate, tell you what, any of me uranium mates are up in Saskatchewan and you want to know exactly where the bloody drill holes are and the orientation of it, Axis Mining Technology are the ones at the coalface. And quite pertinent. We're doing the opposite of uranium today. We're going old school coal. And tell you what, this guy from the eastern seaboard of the US, Matt.hall, who writes the Coal Traders Substack, has joined us today. Mr. Warder, welcome to Money and Mine Cobber from across the ditch.
I love it. Guys, I'm so excited to be here with you. I've obviously been watching the podcast for a long time, but it's a real treat to be here and getting into a part of things. I wish it were on better, human news from that perspective, but I think price-wise, everybody's going to be happy in the end when we get to the end of it. So
awesome. We're flattered you listen in, mate, and that's great. We're reaching the bloody eastern states of America. Trav, JD, take it away, lads. This is your wheelhouse.
Oh, mate, I'm excited. We're talking coal today. We've got a whole show devoted to coal. Normally, I've got to slip it in, one segment like baked into an episode here and there. But this is
this our first ever big coal episode?
I think it could be the first fully devoted coal episode. We might, I reckon it would be, wouldn't it, JD?
I think you're right. And I mean, I don't think we've got a better time to do it. There's heaps going on. Obviously, we spoke about what's going on at Grosvenor a few days ago. Matty, that is, you've recently written up about what's happening at Longview, another unfortunate fire there. Mm-hmm. Got prices kicking up, at least in the Aussie market, prices kicking up, a bit more muted in the US at the moment. And then you've got India looking to restock, just really starting to restock right now. Other countries still a little while away from that. We had some rail disruptions as well. So how's the sort of temperature feeling at your end of town, Matty, right now? Everything sort of coal and I guess kind of specifically met coal related.
Yeah, I mean, the temperature on the pricing side feels pretty good at this point. I think the whole industry was kind of bracing for not really doom and gloom, I don't want to say, but to have kind of we're not partying this year, so to speak, in terms of prices. It's just more like we're going to make a little bit of money and things are going to be okay. And that was kind of the vibe heading into this. And now, I mean, to me, it just goes to show you how hard this business is, how dangerous it is for people to go, that far underground and operate. But as a friend told me not too long ago, there are no upside surprises in terms of mine production. So now, these fires have happened at a time where, usually the market's pretty quiet from March, the end of restocking season for China and India mostly. You have India quiet during the summer, during monsoon season. They start to come into the market, call it, late July, early August after their Q3 budgets open up to buy September lake cans and so they can restock here in the fall. What we'd expected prior was, India's not running on all cylinders like it was last year. I mean, it was a 4-alarm fire itself in terms of macroeconomic activity. And China obviously is not in as good a place. So we'd sort of thought, at least, the folks that I talked to and most of the research houses thought we'd have a kind of muted lower high, if you will, when we get moving in earnest in the fall, probably in the 260 to 270 range. And then we'll fall back toward where the bottom has been, which is pretty well cost-based at this point, down around the 220 level. If you look at a global cost curve, that's right around, if you add up mining costs and then plus SG&A and taxes and bake in a little profit, you kind of get to this 220 range, which I think is going to serve as a soft functional bottom for the market for the foreseeable future. But now you pull off 1.2% of global supply, or maybe up to 2% or a little higher if you just look at mines that produce low vol and mid vol coal, coals that really add to coke strength. And now not so sure. So I think $300 back in play for PLV. With regard to the mine fire in the U.S., it's a kind of a tweener A to B grade high volatile coal mine. The market for that is awfully soft here in the U.S. right now. This is usually a period where people don't sell much at all, and so I expect it to be pretty quiet, even still as we go forward. But when that demand does kick in, the gap, the spread between where U.S. coals have been trading, which we can talk about spot market activity and how that affects assessments later on. But I don't think the U.S. is going to move up a lot until we start to see spot activity pick up here late July, mid-August, and on there.
Matty, the coal fire in the US, mate. What we've talked about Grosvenor the other day. What was the context of that fire? Quickly, how it actually happened.
So I don't know a whole lot. I've gotten a few texts from a handful of folks, but from what I can gather, the situation leading up to it was really similar to what happened at Peabody Shoal Creek mine in Alabama last year. They had a roof fall, and they were filling that fall with void material. And I guess as the void material expands, it gets hot. And I know I'm not a mining engineer. You guys can add in the color on that as to why that happens. But I guess something ignited when they, as it was expanding, and then the coal right by the coal face that caught on fire. So they fought the fire for a little bit. They got everybody out. Didn't sound like anybody was hurt or there were any injuries. And last I heard, they were drilling to inject water and nitrogen to try to put the fire out. I think there's some chatter today about the fire may be out, but there's been no damage assessment. There's been no official statement from the company. So we're kind of, flying dark, as it were, with regards to information. But if last year's, if last year's Shoal Creek accident is, if past is prologue, as Rick Rule would say, then 3 to 6 months minimum, I think, is what you're looking for an outage. And then if the equipment's damaged, it could be. Who knows if it gets that bad? Well, I think we'll find out here within. So.
It's good to hear again that not many people, no one was seriously hurt in this case. You made the comment about the spot market and how that sort of plays in. I think it's worth double clicking on that one just real quick and saying how much of the market actually goes through on these spot prices and just educating us a bit on the longer term contracting nature of coal quickly.
Sure. The steel business in general is a very kind of lumpy business. And, decisions are made as to how much to produce kind of early on in the year. And then you try to hit that target and you re-up your inventories of raw materials kind of in the middle when you have a better feel for how the back half of the year is going to play out. So, although BHP, desperately wanted to move the market from an annual benchmark, which is what took place when I started in the industry back in 06, 07. We had an annual benchmark. BHP eventually moved that to quarterly, and then created this, this kind of more active spot market, which really is only active on your side of the world. In the U.S., the spot market is really paper thin, and it creates a bit of a difficulty when Platts or Argus or these folks try to assess it, because you want to do it as often as possible, but when you don't get any real data, what is the price when there's when the bid or ask is so wide or there's no real deal closing in the market? I think that's something conceptually that I struggle with, but I know that it's a point of contention with some of the producers, because sometimes they don't, the equities behave according to what the indices do, and sometimes that results in maybe unfair shifts or slides in equity prices where maybe they shouldn't.
Yeah, maybe like pull your perspective back for the real kind of zoomed out long term view, and for the duration you've been kind of engulfed in the coal market. What are the giant trends that have really dominated the met and thermal coal markets in terms of sort of funding, development, capex, etc.?
Sure. Well, the elephant in the room has always been ESG. And especially here in the States, the push away from coal-fired generation really was launched by natural gas. It costs you $1 billion to build a gas plant, $2 billion to build a coal plant. The economics themselves kind of, put the writing on the wall. But it really got exacerbated, during the Obama administration when, we started to set standards for mine inspections and those sorts of things at a clip which began to increase costs to a point where those sorts of trends are baked in over time. And Central Appalachia in particular for, over here has been mined since the 1800s. So those seams aren't getting any thicker at all. Mining costs productivity is always going down mostly. Mining costs are going to continue to go up. And when you add in kind of the labor inflation that's been brewing here over the last few years, it causes a concern that, we might not see steel below $500 again, on down the road. But that's been the biggest component of it. It has affected, our country's ability to produce baseload energy. We almost ran out of stockpiles back in 2021, which, caught a lot of utilities off guard. And similar stories kind of happened in Europe. We've produced ourselves out of that supply shortage, but the underlying problems haven't gone away because there's a disconnect between policymaking at the top level and what our world of mining can physically provide at the bottom. And the worst part about it has been just driving away the access to finance, in particular for the industry. So if you can't go get a mine finance, like how are you going to find replacement tons? And what if we need that coal plant on down the road? Or what if we're not, retiring our blast furnaces as quickly as ESG conscious folks would want to? I mean, those are all things I think that are real quandaries. And as a Democrat here, it's something that's very difficult to explain to non-experts because they don't know the ins and outs or how the sausage is made, on our side of the coin. And while I think the broad goals of ESG or whatever are fine, you have to have a plan. You can't go from step 1 to step 100. You have to move through step 2 and step 3 and figure out how you can, cross that bridge when you get there. I mean, to me, this is the big kind of overarching nest of connected problems that the industry is facing, and they're all, largely cut from the same cloth. It's that policymakers don't have the expertise like folks like yourself or other folks in the industry do.
Oh, I don't think we've got much expertise, but
I'm not sure about ourselves.
Having a go, mate. Just trying to put food on the table.
Well,
so Matt, I think
more
that
so
ties
than
in.
a lot of people. Go ahead, sorry.
It ties in with comments you've made on another podcast recently about how you don't really play in the thermal coal space. You're pretty much strictly met coal these days. I think it's worth touching on just for a moment how you see nat gas capping out the upside on thermal coal, and then we can kind of get into your rationale behind a sort of structural price bottom in met coal prices.
Sure. Well, I mean, my track record as a natural gas analyst is pretty terrible. I'm a consumer of that data rather than a generator of it. I lose more money trading natural gas probably than I've made on the coal side sometimes. But yeah, the LNG prices are really, kind of put a ceiling on where thermal coal prices can rise. And on the bottom end, cost inflation has put a floor under it. So when you get these periods where LNG prices are significantly below on a BTU adjusted basis, delivered BTU adjusted basis where coal prices are, coal prices can kind of hang out around, for Newcastle somewhere between $110 to $130 until you see any sort of rise in nat gas price. Of course, when that dynamic changes, you can go pretty high pretty quick. But until then, we're just, I think probably for Newcastle, we're 110 on the bottom and like 140, 150 maybe on the top during demand season. And I don't know if you've had anybody who's covered LNG on the pod recently.
no.
I've had my head down in work for a good 2 or 3 weeks here. But I think that the price outlook is positive. It's better than it was a couple of years ago. But I still think there's probably limited upside to where thermal coal pricing can get to.
It's quite regional, isn't it? That one you sort of can be quite different analyzing that market from where you sit to where we sit here.
Yeah, exactly. Here, natural gas is still, incredibly low price to the point where it coal isn't even in the money. Pardon me, in most power generation regions of the United States. So you run coal, as a baseload provider, but you run it hard when you have to, and you just kind of let nat gas fill in the peaks and valleys there when solar or wind are, one's ramping up and the other's ramping down. It's usually nat gas that fills that void now, whereas before we would add, 30%, just steady hum of coal plants, across the country. So when we start exporting LNG and the market gets tighter here, I think we'll have a bit of a resurgence in thermal coal pricing, which will help. companies like Peabody or Alliance or Consol, who still have significant domestic business on the thermal side. But globally, I think we're pretty well capped. Qatar comes on, I think, full blast next year. The U.S. is going to be exporting. I think that probably limits where thermal coal can go. Still think it's going to be a good business, and if you have a good cost structure, like Whitehaven or Yancoal, you're still going to be able to make a lot of money. So it's not, I don't want to throw a wet blanket on it by any means.
Yeah, Matt, what is like for people who aren't kind of acquainted with coal, and I mean, heck, we'll throw ourselves in that bucket. What actually makes like a premium coal, like a coking coal? What do you pay a premium for? What's the difference in the different, what makes a really, really high quality coal versus not so high quality one?
Okay, well, I mean, the first thing is rank. The metallurgical coals in particular are classified by volatile content. So the more, the best way to think of it is when you put this stuff in an oven and you heat it up, what percentage of the material gets driven off as gas? For a low volatile coal, I would classify those as about 22% or below. A mid volatile coal will be between 22 to 28%, and a high volatile coal will be anything other than that. For the high volatile coals, especially in the U.S., we have additional classifications that are based on its vitrinite reflectance. And I'm not a geologist either, so these are just numbers to me. Haven't run a test on anything. But high volatile A coals in the U.S. have a reflectance of 1.0 or greater, and B coals are 0.99 or lower, broadly speaking. There's also sulfur. If you have coals with a high sulfur content, that gets penalized. So an A coal, if you have high sulfur, which would be sort of like the Longview mine, right, has a reflectance close to 1 or right around 1, but it's a little bit higher sulfur, so it kind of gets kicked down into that B category. That can kind of shove you around different pricing categories like that.
Is that because of the sulfur dioxide gas that would come off during the smelting process? Is that why?
Yeah, exactly. Well, I mean, the more sulfur you have, the less carbon you have. And at the end of the day, you want the carbon, because carbon serves as the reductant for iron ore in the blast furnace. The C picks off the O from the FeO2 to give you molten iron, and then you blow ozone over top of it, and that picks off the last oxygen. You're left with molten Fe, cast that out into ingots and, go make a car or something.
Could bloody make one of these too, lads. Look at this. Look at that bloody drill rig. You know where that's from? That's a bloody WA Waterbores rig.
I'm impressed.
That's a bloody Jero James special. Look at the bloody steel in it. What a fine piece of machinery. So, please, we probably don't give Met Coal enough credit historically in the show. You take it away, then Jero James and WA Waterbores, they won't be going around saving the world by finding water for every bastard that desperately needs water. Can you imagine?
Mate, the world needs water.
I'm thinking implosion.
I need water.
Yeah.
The environment needs water. Mining needs water.
Well, Trav and JD, how many mines in WA do you think would have still been an exploration play with no water if Jero James didn't intervene with WA Waterbores and find the water?
Every mine.
I'd say, minimum 100.
I was going to guess 39.
Yeah.
39. Well,
somewhere in between.
39 to 100 mines are now mines because of WA Waterbores. So good on you, James. We'll keep that Met Coal coming to bloody make your rigs.
I guess like dialing it back to JD's kind of, articulation on the divergence of interest between the thermal and the Met Coal. Why do you sort of see that structural bottom in Met Coal prices, over the last kind of few months, kind of being in.
Right. So the reason for that is twofold. Number one is that the energy transition for the steel industry is going to be very difficult. There's been a lot of talk of using hydrogen, for instance, to replace carbon as a reductant. But the difficulty with that is we don't really have a robust hydrogen transportation system anywhere in the world. I know France wants to use it, is interested in using it. I know a few other regions are too. But the other thing that sort of concerns me is one of the byproducts of injecting hydrogen is water, and water in a blast furnace usually means boom. So from a safety perspective, I have yet to hear, as a layperson for that, a pretty meaningful and easy to recount explanation of why that won't cause problems on down the line. So in general, I think that the transition from blast furnace steel to like electric arc furnace steel is also hindered by electricity prices in Europe, which are astronomical still, and it's limited by scrap availability. And I think when he had the koala on, I think the first time, one of the things that he said was, I'm going to paraphrase it, but you can't recycle your way to growth. If the world is going to continue to grow, be that India, China at a slower pace, whatever, you're going to need virgin material in order to keep up with demand. And so I think it's a combination of the transition is going to go slower than people think. The access to scrap is going to be an issue, I think, for at least the next 10 years. And that provides basically a pathway for metallurgical coal to have, relatively positive cycles as we move through the next 5 to 10 years. And again, buoyed by the cost side sort of underneath it.
What are the implications on the quality of met coals used as environmental standards tighten over the future? Does that draw more of a premium for the higher, Bowen Basin low vol met coals?
That's a good question. I'm not sure, honestly. I would venture to guess that the more quality coals that you use, the lower the carbon emissions are. But I haven't done a carbon study on that, so I couldn't tell you. Certainly on the thermal coal side, that makes a difference. The less, the less subbituminous and lower rank coal you use, if you use high calorific value coal, like Whitehaven produces, you get an efficiency of power generation there that you don't necessarily get from lower rank coals. So there's definitely a gain there in terms of function. On the steel side, a lot of not carbon emissions per se, but a lot of the emissions, sulfur, are captured in a baghouse that runs over top of the coke oven, where you can precipitate out the elemental sulfur. You can precipitate out some other sort of harmful gases and mitigate the emissions from time to time. But from strict carbon perspective, I'm not sure. I think just the fact that carbon is used in the blast furnace is probably would render it, persona non grata to somebody who was concerned about such things. For me, it's just more, we're going to need more virgin material than we think. Scrap isn't quite ready to catch up with yet. Hydrogen is going to be very costly. There could be some safety issues involved. So I think, we'll see steel makers like ArcelorMittal in France, when they build these electric arc furnaces that the governments are paying for them. France is paying for half of them. So it's going to go up. But I think they'll use them as kind of like cost optimizers for their existing shipments that they need to make. So if scrap is better priced at one point in time, well, we can use the AAF now. But if coking coal and iron ore look cheaper, they can go to where the iron units are going to be most cost effective. I think that's probably how they're going to use it.
Matty, can you take us into the sensitivity for the market with, considering Grosvenor coming offline, which was 25% vol, so that sounds about mid-range
it is,
volatile quality, and then probably give a bit more insight into the one that's come offline in the US and the quality of that, but how sensitive the met coal market and pricing is to, sub 2% coming offline of a seaborne market.
Right. So last year, I think it was Cavill Ridge that had the truck slide that shut in production, I think, for a little while. But that was about the same effect right there. So the couple of million tons that came out while BHP kind of rejiggered safety protocol at those operations is pretty comparable to what Grosvenor pretty comparable in effect to what Grosvenor will have on the market, just because it's about the same amount of tonnage. So last year, that happened in September, and that caused prices to go up by 30%. I mean, just in hockey stick, hockey stick up to 363. And from there, the market sort of corrected as the mines came online, and they kind of evened out to like 315. But I think that 30% this particular fall is probably a little bit overzealous. I think probably what you'll see is the point at which those prices came back. So like 300, 315. I think if you're a trader, that's probably where you're setting your sights for the high water mark, because you're not going to have quite as robust a demand coming from India. quite as robust a demand coming from China. But, you know, relative to 250, what is it? 315 divided by 250 is, 25%. So a little bit more muted than last year. It might not hit 300. It might go to 290 or something like that. But that's kind of the range in which I would expect prices to move when we get down there. For Allegheny, now that's a high volatile coal. There's a lot of high vol available in the market right now. It's kind of an off spec coal because it has higher sulfur. So you won't see much happen in terms of U.S. high vol pricing, I don't think, until you start to see some spot market activity in late August. And then really all that happens is the A-grade high volatile coals usually come up and merge with the U.S. East Coast low volatile prices. So high vol A and low vol get the same price, and then the B coals or the lesser coals get a 10, 15% discount off of that. That's usually what happens. Right now, if you looked at the market, there's about 5 or 10% gap between low vol and high vol A. I think that goes away. So that's the net effect of that.
When you kind of like, summarize the things you've described like so far, there's this like, pretty fragile kind of market that anytime there's a bit of a disruption, it really kind of will flow through to prices. There's this like ESG trend which has driven reduction of investment and and there's a true scarcity of the really great met coal assets out there. It just makes no sense when you combine all of that together that you've seen the giant miners like en masse divesting their met coal assets. I mean, Glencore's the exception here, right? But everyone else is just like has been in a mad rush over the last like 4 years to just sell them at low prices. Like, how do you think about that kind of groupthink mentality at the majors?
I don't think about it, for lack of a better term phrase. It doesn't make a whole lot of sense to me. Like, if these are the assets that are throwing off all the cash, you're worried about your multiple, like, spin it out or do something. There are lots of other avenues other than selling it at a price which you're not necessarily getting full value for. But I mean, to me, it just speaks to the fact that there aren't any buyers. You can't find somebody to finance that transaction. BHP had to finance it themselves. Teck had to finance that deal themselves. And if that's going to be the case going forward, it makes consolidation, trying to find some synergies between management or operations or how you run your company or who your customers are. It just makes it that much harder. And while I think the industry is in a better place from a cash flow generation perspective, I mean, I don't think there are any looming worries of bankruptcies that are going to take parts out of the market or anything like that. But you start to look down the road. I mean, Okie Creek runs out of reserves here pretty soon, and there's Dendrobium's going to shut. That's another few million tons out of the market. And while you do have mines like is it Irwin, I think that's coming on. You have the Vulcan guys, Vitronite, that are bringing a mine online. Peabody is going to bring on Centurion. There is production that's coming online, but it's unless you see some more projects, pardon me, you may not meet the replacement tonnage that these mines are coming in to replace. I mean, and this is a theme that's just all over mining. This is unique to coal, obviously, but it's very palpable in the coal industry, and the downstream users all know it too. Like the Indian end users are wondering where they're going to get their mid-volatile coal from in 10 years, because it might be an issue. So like that's really where I'm really interested to see what this M&A cycle brings, because there's just very little appetite to participate in it yet. I mean, you're starting to see private credit, I think, take note. But unless there's a big, movement en masse, these prices that you're seeing are going to be there for a long time. And don't get me wrong, I'll take it as an investor. I'll take the high prices and the margins, and I'll not know what the share price is and be happy about it. But it's a worry. It's an existential worry, I think, for if you're making steel.
I'm actually starting to get a bit bloody worried about I guess after this chat about the long-term supply of coke and coal, because more just around the longevity of DSI for the ground support. Like,
Tell me what you mean.
well, like every bit of ground support is steel. Take away coking coal. Wouldn't that have
see what you mean.
flow-on effects for the mining industry? I'm starting to actually just had this wave of sort of concern. Yeah. Like because I don't have to repeat myself on how bloody integral DSI is for both the underground metalliferous and coal industry. So there's a double whammy. Like, to get the coal out, you need the DSI bloody ground support to keep the bloody roof up.
Circle of life.
Oh, mate. And so, look, coal miners and capital providers need to understand right now, if there is not enough coking coal, don't worry about thermal and all that, I'm talking coking, the world would effectively end because DSI won't have enough ground support to keep the world from imploding. There is two things that, like, between WA Waterboards and DSI, like the risk of world implosion, holy snap of duck shit. So anyway.
I think you should just, everyone should just say thanks and give Derek Hurd a call.
Yeah,
just to express your gratitude and chuck in an order.
Thanks to me for identifying this world issue.
When coking coal gets added to the critical minerals list, it's going to be because people, the big thinkers of the world realise that you need DSI to keep the ground support in the mines.
Yeah. Simple.
To continue on Trav's kind of line of thinking on the sort of fragility of the market, we've seen obviously a bunch of shocks. So you've got bridge collapses, fires, obviously the sort of unfortunate situation with Russia and Ukraine. Then you've got Queensland royalties and these sorts of things. Are there sort of risks you see, given your experience watching the market, that you think are a bit underappreciated and could just pop up around the corner?
I mean, underappreciated, no. I mean, I think the biggest risk is what's China going to do? I mean, we got a new 5-year plan coming out here relatively soon. What is it going to look like? Is it going to eliminate overcapacity? Are they going to, green themselves up by shipping, coke production or some other production overseas to like Indonesia, for instance? Or are they just not going to produce as much? Is the competition between the U.S. and China going to make China less of an industrial power? Like those are sort of like the, I think, important questions. If we went over to the other, to the other side of the world and thought about Russia, at some point in time, and I mean maybe after the U.S. election, that war is going to end, and that steel industry is going to get rebuilt. So I don't think anybody is really looking at Ukraine from an upside perspective. But if that 8 million tons of demand came on tomorrow, I mean, I'm not sure where it would come from. And like those are the sort of twin dichotomies I think that we have to wrestle with. What is China going to do, and how is that going to affect global supply from a trade flow perspective? And then how does Russia-Ukraine get resolved? And then the other big one is, can Australia produce? We've had it's been 4 years since COVID now. And the BHP mines and the Anglo mines, proven or accepted now for the purposes of this discussion, are all still, 10%, 20% lower than where they were in 2018. And every research house has some sort of Australian production recovery in terms of met coal going out to the next decade, but we haven't seen it yet. And that's something I'd probably put back to you guys. Is that even possible? Is that going to be a certainty of an outcome, or are we just kind of locked in this, higher cost world where it's difficult to produce and you don't have enough miners for a while?
Oh, it's easy for wages to go up. It's very hard for them to come down. Like
yes, sir.
That is, they talk about rise and fall. It's, I think Stewie Tonkin from Northern Star said on the call, it's just usually rise and rise because you start cutting wages. Jesus Christ, they all just go somewhere else. Wages affect the cost of obviously the personnel and the equipment, and because it's the people paying to produce. Yeah, so it's not directly correlated to inflation. That's for sure, is my opinion.
Mm-hmm. Now, I do think that over time, especially here in the U.S., as when we do get these periods where prices fall back, and you do have, I hate to say it, but when you do have accidents like these, and there's always something that happens in every cycle that surprises to the downside. there will be, some additional labor on the market. I do think the labor inflation will sort of take a breather, pause eventually. But yeah, to your point, like, is it going down? I don't think so.
Nah,
Not anytime
doesn't
soon.
appear to be. All my mates in mining are still getting paid exactly the same. So there's a bit of that's can't get any truer than that.
It actually made me think of this just now. With Japan and the yen where it is, if the U.S. dollar weakens pretty significantly over the next 4 years, and I think that's a possibility if Trump's in office. If the yen, does a revert, like there's a chance that we could see the Australian dollar rise in value as well, which increases costs, which increases the global cost curve. And I don't think anybody really has that on their bingo card either. And I'm certainly have no track record as a macroeconomist or currency analyst, but it's that's something else that I think is probably worth watching over the next 3-4 years.
Well, increased cost and lowering the value of the exports as well. So that's going to be a big double whammy.
Yeah. What's your visibility into the thinking of the large steel mills of the world in Japan, etc., and how they might be fearful of the scarcity of the coking coal that they need for multi-decade kind of outlook?
Mitsui, when I was at Wood Mac years ago, I was at Wood Mac until about 2015. Spent the first 10 years of my career there, actually building up their asset level coal analysis, and then did the same for iron ore and steel later.
I've used some of those models in a banking life.
It's if you use the ones in the Americas for Brazil or whatever, I hope they still work. We tried to do as best as we could when we built them up, but we used to be pretty close with Mitsubishi. I had really good contacts there. My last couple of years at Wood Mac as a steel analyst, and they saw this coming as well. So they'd already started to make investments. Obviously BHP and Mitsubishi have a big alliance, in Australia, but even the mine here in the U.S. that just had the accident the other day, it's partially owned by Mitsui and POSCO. So they're making the investments already, in trying to make sure that they have some security of offtake. I suspect you'll see more of that. I wouldn't be surprised to see a steel company come in and take down, say, 20% of Blackwater and Daunia here at some point in time, because everybody is very conscious of there's very little high quality coal. If you need a certain grade of even semi-soft or PCI, but how to use it behaves in your coke oven, like now's the time when when prices aren't $600, that I think people would try to come in and lock them up. And now that I think about it, that's probably going to be a trend, I think, during this M&A cycle as well.
All right, on a slightly different topic, guys, dividends versus buybacks. That's one that dominates the narrative with these really strong cash generative business.
Mate, throw in reinvesting the capital in the mines.
Well, when you can do that, when it's on the table, but it's a bit nuanced. Given you're in America, we've got quite flexible and quite good dividend policies here in Australia, but
right.
You seem to be a real convert of the buyback sort of philosophy, and I think you can point to AMR, and that's the go-to example. There we go.
Mm-hmm.
So I'm keen to hear why you're a convert, and I'm not sure how closely you've dived into it here in Australia, but do you hold the same view for the Aussies?
Not necessarily. The franking credits, I think, have a pretty unique, financial benefit to them down there for sure. In the U.S., however, I was never really on any team, and then we've seen what happens when you put a whole mess of capital to work buying back stock at a time when also the wind is at your sails. AMR reduced their float by 30%, and they tripled. My price target for them was always around 450, and they got up there way sooner than I thought. Just because they were juicing that buyback all the way up till right at the end. Now we've corrected and come back, but I think here buybacks make more sense if you're not going to use the funds to say reinvest in new mines, or you're not going to grow or anything like that. It's kind of the only other option that's left. And buybacks have the benefit of right raising the share price to a point where if you did want to make an acquisition, you can weaponize your share price in order to do it. And that's one aspect I think that will benefit, AMR relative to others, as we move further into the M&A cycle. I don't think they're going to make an acquisition anytime soon at all. But when they do, they have the option to do it via equity. And that will be a really interesting sort of trick to pull out of their sleeves in a world where there's very little lack of access to financing, those sorts of things. So, but yeah, I think for Australia, I might be on team dividend down there, but for now we'll defer to the AMR boys.
Before you head off to your poker game, this evening your time, this morning our time, I really want to get your one sentence kind of view on a bunch of coal equities out there. We sometimes do this segment overrated, underrated, and I reckon we'll do it with the coal equities. But I'll put a little twist on it. Overrated, underrated. You say what it is, and just give one sentence on why with each answer. And I'll start with the international ones, the ones maybe on your side of the world first, and then make my way to the ASX, and then go down the degen curve on the ASX too.
All right, let's go.
All right, Glencore.
Underrated, hands down. They're going to make so much money from this acquisition in tech. Like, I don't necessarily always understand why the stock trades like it does. It captures a lot of beta, the copper price, for instance. But I mean, this is just going to be a money machine once everything kind of goes down with the Elk Valley resources.
Peabody
underrated, and the reason why is I don't think people have fully realized exactly how much Centurion changes their free cash flow structure. Arch rated.
So just neutral.
So yeah, their growth is behind them. So now they either have to double down on buybacks, and they need a good price environment for to do that. But they have, like Peabody, they have a Powder River Basin thermal coal albatross around their neck that is very difficult to do anything with. Peabody's already got at least the capital to outlast it. Arch is in a little bit different situation with it, but the met coal assets are bang on awesome. And at the end of the day, they'll carry them through a pretty decent buyback program, but I need to see a little bit more first.
AMR.
My guys. Best management team, period, stop, in the industry, led by people who, I'm biased because Dan Horn probably taught me more than anybody else about met coal in the industry at all. But also, I think Andy Edson is a best in class breed of CEO for this new generation of leadership that's going to cycle through. People love to work for him. He's a fantastic human being. He always got shareholders at the forefront of his mind.
Pembroke.
Probably rated too. The issue that I have with Pembroke is that the quality is not quite there. It's going to be PCI. It's going to be, semi-soft and those sorts of things. And, PCI, as you get further out into, say the next decade, PCI is actually at some risk of being displaced by hydrogen. If you can inject hydrogen, PCI is the first thing to go. So probably overrated to rated.
Warrior Met Coal.
Still massively underrated. I have no idea why this multiple is still where it's at. I suspect it is from some level of lack of messaging around what they're going to do after Blue Creek comes on. But it is Blue Creek is going to be a massive game changer for them. Still underrated and will be until we hit under 20.
Pivoting to the ASX names, and there'll be some thermal names thrown in here too. Whitehaven.
Underrated still. Blackwater and Daunia are transformative for them. They've gone from 100% thermal coal to more of like a Peabody 50-50 split. The cost structures of both of those mines are excellent. They'll be able to sell down 20% of the project. Still upside, even though we've had a pretty good run.
Yancoal and ding, ding, ding for me.
Yancoal, honestly, best in class cost structure for thermal coal. The dividends are bang on. If I had to own one thermal coal stock in Australia, it would be Yancoal, and I would take to the desert island.
Coronado.
Overrated, very overrated. Great assets in the U.S. Buchanan is a wonderful mine here in the U.S., although they're having some geological problems right now, which happens from time to time. The Pocahontas 3 seam down there. The Logan County operations aren't super fantastic, but they function. Curragh, however, those contracts for those domestic contracts for Curragh just pull it underwater, and I can't unless you can get out from under those in some way. Like Coronado is not at all of interest to me.
New Hope.
New Hope rated, good cost structure, good thermal coal mines. We're expanding a little bit. I think the price outlook for Newcastle coal is pretty stable. You get a little bit of growth, I think. But yeah, rated, not so bad.
Stanmore.
I think Stanmore is underrated. Again, you have these assets that are pretty decent quality. They're not at all connected to the thermal market, so they'll be able to participate in some of the upside because they get a discount relative to the big boys. The royalty doesn't eat as much of the profit as some of the others. So I like Stanmore. It's definitely one I want to play for the cycle.
I'm going to pivot to the degenerate names now. Bowen Coking Coal.
Not going to make it.
Yeah. Terracom.
Overrated again. Like I don't know too much about them. I've never built a model on them or anything like that. But again, just that sort of thermal exposure to pass on.
Cocal.
Ugh. You have to.
You answered it.
And Bathurst. I didn't even know this company existed till Bogan tweeted it yesterday.
Bathurst underrated. Could be sneaky.
Okay.
They own a piece of a project in Canada called Crown Mountain, which is also connected to Jameson Resources, which you didn't mention. And I think that project eventually goes. The world needs more high quality mid-vol coking coal, and that's actually one of the solutions that's out there that's probably viable.
Awesome. JD,
I love the extended overrated, underrated is because we want to know more about met coal. So we thought we'd just get you to explain it to us. Yeah.
That's right. I am loquacious as hell. It's hard to get me to say just one sentence. I'm very koala-esque.
No, that was great.
Oh, no, trust me, you say heaps less than koala, mate. Don't worry. You're all good there. Mate, that was sensational, mate, and we can't thank you enough for tuning in the evening for us. Yeah, that was friggin' awesome. Learnt shitloads as per usual. I am
so stoked to be on. Like I said, I've watched you guys a whole bunch. I love what you're doing, and my earbud fell out there. But no, anytime you guys would like to have me on, love to. I'm at your disposal. Big fan, and can't wait to watch the next one.
Fucking made my day, mate. There is a WhatsApp chat group coming your way with us.
Really appreciate it, Matty. And I think we should just point people in the direction you've taken over the Coal Trader Substack, obviously website and everything. So for those that do want to go and learn a bit more, I mean, I could chew your ear off for another few hours, but there is a wealth of knowledge out there that you've sort of contributed to and put together. So go and get into it if you're keen on that. Sure. Yeah. Thanks for that. Obviously you can follow me at mfwarder on Twitter. Or alternately you can, I'm the publisher of thecoaltrader.com. Just go to thecoaltrader.com. It's pretty honestly low price service for the type of access to price information, at least that you get. I'm in the process of getting a proper data redistribution license. So I think we're going to make a lot of upgrades as we go along. And then you can follow the other accounts connected to the Coal Trader on Twitter. That's at Coal Newswire, where we get kind of AI-driven summaries of steel and coal and power generation related news. And I select 3 or 4 of them a day, and we tweet those out. In general, we'll run parallel articles like that on Coal Trader. And then for premium members, there is the trading service, which I've taken over
for better or for worse. Like I said, not much of a trader, more of an investor these days, but that is at the Coal Trader on Twitter as well.
Awesome, mate. Hags, if you're listening, same applies here. If you're not subscribed to the Coal Trader Substack, it's un-Australian. So get on it, everyone. Righto, Matty, mate. Bloody Ace King, go all in. Pre-blind. All in pre-flop. Mate, thanks very much, mate.
Thanks so much for having me on.
Awesome,
It's my
mate.
pleasure. Anytime.
There you bloody go. What an absolute gentleman of a bloke. Hey, God, you know, you get that energy. Just one of the nicest blokes we've bloody talked to. So, yeah, and Jesus Christ knows his shit. I love that overrated, underrated.
Couldn't agree more, Matty. He's a wealth of knowledge.
Poor old Coronado. Only, you can tell he's bullish because everything was underrated or rated, except Coronado. And the shit ones. Yeah, and the shit ones. No, legend. Get on the Substack, everyone. Bloody fucking wealth of knowledge.
Awesome.
Righto. Let's thank all the bloody, just the bros and sisters for that support us. I love them. Axis Mining Technology, Mineral Mining Services, VRIFY, GetWet Solutions, DSI Underground, Silverstone, CRE Insurance, WA Waterbores, K-Drill, and I'm sure there's a bloody spark chart in there somewhere.
Hoodaroo.
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 The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.